sell low, buy high, and other stupid money decisions this week. Hello, members, super savers, and bond course fans. I hope you're healthy and well. It's been another wild week in the markets. Bond yields were up, bond yields were down. The equity markets took a hit as well, and then bounced back. And the roller coaster ride may continue. So let's talk a bit about some of the comments and emails you've sent our way, and the smart and not so smart decisions that folks have been making during this turbulent period. Here are the 3 topics that we'll be covering in this week's update video. 1. Who made stupid or rash money decisions the past weeks? And how can you avoid this the next time there is a market sell-off? 2. Where did Treasuries end last week? And 3. What's on the upcoming Treasury auction schedule? And what are the highest yielding new issue agencies, corporates, and brokered CDs currently? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. The answer to this question is a lot of folks made stupid or rash money decisions in the past 2 weeks. Buy low, sell high. We've all heard this before. That's how you make money in the markets and in life even. Well, what sounds good in theory doesn't always work out quite as planned in real life. As we can see from this Bloomberg article this past week, market turmoil pushes 401k trading to the highest since March 2020, 8 times the average daily volume since those early pandemic days, according to the Alight Solutions 401k index. Anxious retirement savers made changes to their accounts as equities tanked and volatility soared Monday. Now, the first thought that crossed my mind when I saw this headline was I hope some of these retirement savers are picking up equities on the cheap and not doubling down on bonds while yields are getting crushed. Scroll down this article further, though, and we see that this was not the case. As stocks tanked and volatility soared, almost all of the 401k action was a flight to safety. The retirement savers here were, in fact, not buying low and selling high. Quite the opposite. They were selling low and buying high, selling their stocks at low prices during the mini crash and buying bonds at high prices and low yields at the same time as everyone else. The classical flight to safety instinct during times of market uncertainty and volatility. So, while I hope that all of you who wrote in about not being able to get into your 401k and brokerage accounts on Monday were able to get in eventually, I also hope that you were indeed going into those accounts to pick up some equities at lower prices and or to continue dollar cost averaging into your bond and or stock holdings. If this is not you though, and you did end up making some money decisions that you now regret, how can you avoid making the same mistakes the next time there is a market sell-off? Well, we had an ad hoc member live on Monday afternoon when the market was in full panic mode. And as our YouTube super savers can attest to, it really was on quite short notice. So a special thanks to all of you who could make it. If you couldn't make it, you can still catch the replay of the member live. I've linked it below in the first pinned comment. And one of our YouTube members summed up my advice for days of sudden high market volatility and uncertainty from that live quite nicely. 1. Don't listen to the noise. 2. Don't log into my account if I'm not planning on trading. 3. Keep on dollar cost averaging. Stick with the plan, basically. 4. Review my allocation if I feel nervous today. I don't because I've been listening to your channel for over a year. Well, that's good news. Listen, markets go up, markets go down. Both bond and equity markets. But so long as you have a diversified portfolio over and for the long run, those blips will likely smooth themselves out. Nervousness during days of high market volatility and uncertainty is on the one hand normal. Even I can get a bit antsy during such episodes. But on the other hand, that anxiety could also be a sign that you may be overweight in certain asset categories when measured against your personal preferences. So, If you've been super nervous in recent days, then perhaps you may be too heavily weighted in equities. Or perhaps you may need to start dollar cost averaging in larger amounts into treasuries and other fixed income products. Or maybe even think about certain types of annuities. So review your asset allocation with a calm head. But don't do anything stupid or extreme like selling low and buying high. And don't follow investment advice from strangers online. As I said on Monday towards the end of that member live, I'm a strong believer that we don't have to always make the smartest decisions in life or money. We just have to avoid making the stupidest, rashest, or most impulsive mistakes on days when the rest of the world is also freaking out. And if you know that looking at your investment accounts on a bad market day will lead you to make decisions that you may regret in the long run, then just don't look at your investment accounts that day. Remember, for most in our community, we're in it for the long run. And it seems we were right to keep our nerves this time, as both bonds and stocks recovered quite a bit by Friday. Now, I can't promise you that every recovery will be as fast as this week, or that things won't take a turn for the worse again. But I am personally convinced that the advice to keep a cool head in turbulent times is generally the right one. So, with that in mind, let's move on now to the next section of this video. As we so often do at the end of a week, and especially now that we've had 2 turbulent market weeks in a row, let's see where we stand and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. The 1-month T-bill stayed unchanged. The 2-month T-bill was down a few basis points, but all the other maturities were up for the week, as we can see here. Recovering to a certain degree from Monday's flight to safety that I mentioned before, but also driven partially by falling U.S. jobless claims and less demand for this past week's Treasury auctions. Plus, the Fed repeatedly let the markets know that they won't be rushed into hastened rate cuts before they feel it's the right time. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. The 20-year and 30-year T-bonds are now back up slightly from where they started on January 2nd. And the 10-year Treasury is now almost flat, down just 1 basis point. But yields across all these other maturities are still lower than where they were at the start of the year, with the biggest differences still seen in the 1-year and the 2-year Treasuries. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. This overview is meant to give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what is shown here. With that in mind, let's move on now to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Things are relatively quiet on the auction front this coming week. All the weekly T-bill and CMB auctions are happening as usual, as you can see here. Otherwise, there are no other major T-note, T-bond, or other Treasury auctions. However, the BLS will release the next inflation readings when it publishes the CPIU numbers for July on August 14th. So, depending on what those inflation numbers will look like, it may or may not be another interesting week in the bond market. For those of you interested in agency and corporate bonds for a bit of a higher yield, here's where the highest yielding new issue agency bonds stand at the time of this taping on Fidelity's platform. Here's where the highest yielding new issue corporate bonds stand at the moment. And here's where the highest yielding new issue broker CDs are currently. Do note that these rates are generally lower than the bank CDs we've shared with you in these recent top CD rate videos. Also linked below for you. So, if you want to learn about the safest, easiest, and fastest ways to get started with bond investing and building out your bond portfolio, especially in times that may see continuing market turmoil, then check out this video here on our 2024 bond courses. Or come join our next live member Q&A on August 21st at 6 p.m. Eastern Time, 3 p.m. Pacific Time to continue the discussions further on all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for you. All right, members, Super Savers, and bond course fans, I hope you enjoyed this video and learned something new. Good luck to everyone who's planning on picking up some bonds and CDs this week. And see you again very soon with more brand new wealth building content for your financial journey.